A big hello. Union Budget 2023 is less than 2 weeks away, and we are into the fifth episode of Budget with BS. I'm Nivedita Mukherjee, presenting this very special budget show along with Ruchika Chitravanshi.
Hello, everyone. We've already covered a lot of interesting issues in the previous episodes, including taxation, manufacturing, and the geopolitical backdrop. We promise to make the show even more interesting as we go along.
Yes, I can almost feel budget in the air now.
Yes, that's
And you know
true.
what? Even in Davos, World Economic Forum, business majors are talking about Union Budget 2023.
Yes.
The spotlight today is on an area that is of interest to any student of economics and also to a political watcher ahead of 2024 general elections. Yes, we are talking about the disinvestment initiatives of the government. Ruchika, do you expect anything big in disinvestment?
Well, for that, we need to listen to what Arup Roy Chaudhary has to say to figure out whether the government would focus on completing the pending disinvestments or bring in some fresh items on the agenda.
In some ways, the centre's recent track record on divestment has been mixed. Air India was finally privatized and the Life Insurance Corporation came out with an IPO. But still, stated divestment targets have mostly been missed in the past few years. This year, the Finance Ministry's Department of Investment and Public Asset Management, DIPAM for short, has a priority, which is to complete pending transactions.
So what are these pending transactions? These plans feature Shipping Corporation of India, Container Corporation, Bharat Earth Movers Limited, and the Nagarnar Steel Plant of the National Mineral Development Corporation. There is also the pending privatization of IDBI Bank, though technically it is not a state-owned bank anymore, with LIC Limited and not the centre being the majority shareholder. Some of these transactions have been pending since 2019. It may not be smooth sailing though. There will be challenges similar to the ones seen in the COVID-19 pandemic. With most advanced economies expected to sink into recession in 2023, investors will be cautious. Despite such challenging conditions, the centre may add some new mid and small cap companies to its list of privatization in the coming financial year.
Disinvestment receipts stand at around 40,000 to 50,000 crore. And so what we expect is that despite the setting a target of we have kept our numbers around 50,000 crore, but we do expect a shortfall in that as well. So downside risks do remain for this target in terms of in terms of the unfavorable macros and the higher interest rate regime, and the cost of capital raising of capital is an issue these days. So considering these into factors, the unfavorable macros, the higher cost of capital, we do see a shortfall in our target of around 40 to 50,000 crore, which we have set.
After years of unrealistic divestment targets, DIPAM had a more achievable aim of 65,000 crore rupees in financial year 2022-23. It has garnered 31,106 crore rupees so far. Efforts are on to reach the target, even though DIPAM Secretary Tuhin Kanta Pandey has made it clear that some pending big-ticket deals like IDBI Bank will happen next fiscal. Over the years, there has been a slight change in how the government approaches divestment, whether through privatization, initial public offerings, or minority stake sales. The approach is more towards multi-year plans rather than just yearly targets. Even then, Business Standard has learned that the target for financial year 2023-24 may be lower than the current year. Additionally, as per some reports, DIPAM wants dividends from non-financial state-owned companies to be a part of the overall divestment target. So far, dividends have been counted under non-tax revenue for the government, while divestment is seen as a non-debt capital receipt. This means that these proceeds can only go towards the centre's capital expenditure.
Certain sectors like banks, for example, there is significant sensitivity around strategic divestment, and which is why probably they will take backstage. And certain sectors which are more commercial in nature, where it is largely, anyway, the sector is largely run or dominated by private players, there probably we'll see higher prioritization. That's my viewpoint, because you see, one is the government's intent, which, as I said before, is likely to be influenced by the fact that it is election year. But I think the other side is equally important, which is in terms of the private sector interest. And that's where I do expect certain sectors to be more amenable to attracting investment than certain other sectors, given the global economic situation which we have on hand.
There is also the matter of a planned privatization of 2 state-owned banks and 1 general insurance company, which the finance minister announced in 2021. While no candidate for privatization have been announced, there was a lot of resistance from bank employee unions. With key state elections coming up in 2023 and the Lok Sabha elections in 2024, it is unlikely that the government will move ahead actively with these plans.
The past few years have been tough for the centre's divestment and privatization plans. Global markets and investors' money have been in constant flux, mainly due to the COVID-19 pandemic and geopolitical uncertainties. The effects of the war in Europe, the spike in commodity prices, and the actions by central banks worldwide are likely to make investor interest in the centre's PSU offerings more uncertain. In such a scenario, DIPAM will aim to get long pending deals across the line.
After the big ticket transactions like the sale of Air India and LIC IPO, disinvestment has been a slow mover, and Aroop's report suggests that the focus in the coming year would be to clear the pending transactions and perhaps add a few new names to the list.
I wonder how the budget announcements on disinvestment will move the markets. That brings us to today's interview. Our markets expert Puneet Wadhwa spoke to U R Bhat, co-founder and director, Alphanity Fintech, to find out the mood of the markets ahead of the budget.
Hello, welcome to the show. I'm Puneet Wadhwa, and today we have with us U R Bhat, co-founder and director at Alphanity Fintech with us. Hello, Mr. Bhat, and welcome.
Good morning. Thank you.
Do you see the government dole out SOPs to the middle class in this budget in February, as this will be the last full budget ahead of the general elections in 24?
Well, I think if you see the track record of the government, they have been quite responsible in terms of giving out doles. And of course, they have also floated this idea of freebies need to be controlled, subsidies need to be brought down. So therefore, I don't see them doing anything dramatically more than what already is there for the middle class. But though, for the poor, they are really doing whatever free food and stuff like that they're giving. I think that the concentration is really on helping the really poor. And as far as the middle class is concerned, in helping them build assets, like say these the housing loans and homes and stuff like that. I think that is probably the focus of the government.
So which sectors, according to you, will get priority in this upcoming budget?
Well, as you said, this is just the last full budget before the election. So therefore, I think they have really been giving a huge thrust to infrastructure. Infrastructure is something I think they will continue to press ahead. Then, of course, defense is another important imperative for us. Plus, of course, employment generation, especially manufacturing, the PLI type of schemes, production-linked incentive schemes. I think these are the ones that they would probably press ahead with, rather than coming out with newer schemes where there is not enough time to implement and show results.
But do you think that the markets will react positively to all these schemes?
Well, I think if you see, I mean, just going through the record of the performance of the market 1 year previous to the elections, general elections, and for probably the last 4 or 5 elections, that year has not been very good. So 2023 is that year, just before the general elections. So generally, the elections have not been very good, and the market has not really, because the market is a bit nervous about the outcome of the result, outcome of the election results and stuff like that. So therefore, the market doesn't do very well vis-a-vis the budget, but there will be certainly other macro factors, international factors that can influence the direction of the market.
Okay, so calendar year 23 also has a number of state elections as well. Do you expect more SOPs for the poll-bound states?
Well, I don't know whether the government can really give specific SOPs to particular states, but I think what they could probably do is when they're actually announcing new infrastructure projects, say, for example, railways and stuff like that, that they could probably concentrate on the poll-bound states so that, they can make a difference there in terms of the impact that it will have on the citizens there.
So at the macro level, how much room does the government have for fiscal extravagance? In terms of budget deficit, inflation, growth projections, what number would the markets be comfortable with?
Well, I think quite a lot of what the budget has said, last budget has said, is sort of factored into the market. And if you really see there is a certain buoyancy on tax collections, and even on direct tax collections. I think there is quite some buoyancy, and the expectation is that the tax collections will be probably about 4 or 5 lakhs more, 5 lakh crores more than what was initially budgeted. So they have some room. But of course, they've extended this free food for the downtrodden for the next 1 year. So therefore, that will take probably another 2 lakh crores. So therefore, they have some wiggle room, and I think they will make the best use of that and try to ensure that the poor strata of society is taken care of.
Okay, so do you think it will be something like what numbers would the markets be comfortable with as regards to the budget deficit, inflation, growth projections?
Well, this time the projection is about 6.4% of GDP, and I think there is certainly a trend that it should come down. And of course, the last budget before the election is not the time when you expect it to come down dramatically. But I think it would probably not come down too much. But I think it will be somewhere in the region of 6 to 6.4% is, I think, what I expect. Because even though the intention is in the medium term to bring it down to wherever 2-3%, but I think it will be more gradual because of the elections, and so therefore I think there is a need to spend more money to modernize infrastructure, because they've given a huge momentum to modernizing infrastructure, and so that momentum, if it has to continue, they'll have to spend much more on infrastructure.
And what about the so-called green push of the government?
Well, that is part of the modernizing the infrastructure story. And today only we just saw that hydrogen production. I think hydrogen power. There's a huge incentive that is being organized. So I think basically they are moving towards green power, and I think the pace at which this government has moved towards green power is dramatic. In fact, I think we are likely to meet our targets that we set for ourselves even earlier than what we had initially envisaged. I think that is something that is going to invite a lot of attention in the budget and by the government in general.
Okay, talking about taxes, Mr. Bhat, there were reports that the government may tinker with the capital gains tax, long term as well as the short term, either on the tenure side or on the rate of tax. What are you hearing, and how will the markets react if it does come through, and what if it doesn't?
Well, as far as capital gain tax, we have created a system which is very complicated. There are different tenures for long and short term. There are different types of assets have got different stipulations. So I think this is becoming very complicated. I think the effort of the government has always been to make it simple. So therefore, I think they would probably bring down or change the qualification for being classified as a long-term capital gains. Today, it is anywhere between 1 and 3 years. So I have a suspicion that they would probably bring it to 2 years flat for everyone. Then long-term capital gain has been introduced at 10% above 1 lakh. But I think, in my view, that is clearly a breach of faith, because when they introduced security transaction tax, the reason was they introduced security transaction tax and put out long-term capital gain tax. So I think they should do one of these. It is not right for them to have both, because the whole logic of STT is lost. So either they should retain STT or get rid of long-term capital gains, while saying that long-term capital gains probably will have to hold for a slightly longer period. That is fine. Whether if it's 1 year for shares and equities, it could be 2 years, and they should probably abolish that. Short-term capital gain at 15%, I think, is reasonably fair. I don't think one can quarrel with that number. So I think generally there would be a reworking of these tenures and tax rates, and of course the incidence of lots of these surcharges and cessors and all that. And they have to rationalize all this.
Anything for the savers?
For the savers, I think the only real sort of exemption that is available is Section 80C, which is at 1,50,000 for various specified type of investments. But I think this has to move along with inflation. I think since it was fixed at 1,50,000, I think inflation has really clocked quite some big numbers. So therefore, I think there's a case for these 1,50,000 to be increased. Plus, also, I think the government has to make NPS even more attractive, National Pension Scheme. I think that special exemption for 50,000, I think that also needs to be increased. I think these are, because finally, if you are going to have a defined contribution scheme. So then I think you need to encourage that.
Do you think that with the equity markets being quite buoyant since the past few years, do you think that the divestment target could actually get a push?
Well, I think divestment targets have been sort of moderated over the years. It is not as aggressive as they used to make, and they used to achieve very small fraction of that. But these days, I think divestment targets are also lower, and the achievement level is also much higher. So I think divestment targets can be slightly higher, and I'm sure that is one of the means of finance that they would certainly use in order to meet the moderate fiscal deficit targets that they'll set for themselves. I think there is a scope for further, because I think there's a lot of interest in PSU stocks now in the market, especially defense and the like, defense engineering and the like. And therefore, I think the government will make best use of that by doing some divestment.
Retail investors have been a backbone of the market all through 2022, at a time when foreign investors have exited Indian equities in search of more lucrative markets. Can the government reward them by abolishing, things like tax on dividends, etc.?
Well, actually, that is
not what the expectation is.
Another big issue is again about tax on dividend, because dividend is one stream of income that has been taxed already, because all corporates already pay tax, and after that again, levying tax on that is absolute double taxation. I think that is something that needs to be thought through. But at least, even if the requirement of tax revenue is much higher, I think there was this ease of revenue collection by the dividend distribution tax. But this, my own feeling is that if you allow the dividend to be taxed in the hands of the investor, I think it's much more inefficient, much more difficult to collect. And I think the amount of effort that goes into collection is going to be much higher. So either, in my view, since the stream of income that comes as dividend is already taxed, the tax level should be much lower, and probably the dividend distribution tax, even if the taxation has to be there of dividend, I think that's a more elegant way of dealing with it than allowing it to be taxed in the hands of the investor.
Okay. Lastly, what about the foreign institutional investors? What are they seeking this time around?
Well, I think quite a lot of their concerns have already been addressed. But of course, ease of investment is something that may not be part of the budget. But I think SEBI is working on this, and that needs to be done, because we have too many rules which, actually, we are probably the only country who actively discourage non-resident Indians to invest in India. Because, well, say for example, most other countries, the non-residents are the backbone of they discourage non-residents investing in India through various rules, regulations, and sort of barriers. So I think that needs to be looked at. Non-residents have to be, because they are the ones who understand India best, and they are probably the pool of money that they have, which can come into India, is very large, and I think that needs to be facilitated. FII, foreign portfolio investors, I think it's okay, but still, I think the ease of investing in India needs to be increased quite dramatically. I'm sure SEBI is working on this, but I think much more needs to be done.
One more additional question, Mr. Bhat. What if there is a rationalization of, do you expect any rationalization of cess and surcharges across the board?
Well, that
and
needs
how
to be
will the
done.
market react to that?
Well, I think that would be, even if the taxation is increased by, a couple of percentage points, but, this cess for some, surcharge for some, surcharge at different rates for different streams of income, I think this makes the whole effort very complicated. I think if the idea is to simplify the taxation structure, I think, I think I would certainly vote for doing away with cesses and surcharges. Because cesses should have a limited life. It cannot be a permanent feature. Because cess is meant for a particular sort of activity, to support a particular activity. So I think cesses and surcharges have to go. You have to define the income tax levels for the medium term. Because, like, say, for example, indirect taxes now are virtually out of the budget, other than, say, probably customs, because now it's part of GST, where I think there is a lot of predictability. And all investments happen when there is predictability in terms of taxation. And fiddling with this every year or even within the year, I think is not very conducive to encouraging investments. I think they need to do away with all this and have a very simple tax structure, even if it is a bit more than now.
What can India Inc. expect?
India can expect, actually, I think the government is very much concerned about private sector investment. So there could be some stops for private sector investment, which would be, in fact, I think there is a very good case for encouraging sort of investment into venture capital funds and angel funds and the like, because they are the ones who create these businesses. encouraged to create these businesses. And since we have so much of a thriving startup culture in India, I think getting finance for the startups is not easy at all in India. So therefore, we should encourage that startup culture by giving stops to VCs and angel funds and the like. And I think something like this section 80C that we have, I think we could carve out something and give them probably some more. Like if you remember, the old section 80CC used to be there. Something like that should be brought back for venture capital funds and angel funds, because they are the ones who create new entrepreneurs and create employment in this country. I think that is something. And India Inc. itself can probably expect some swap for investments, where like say, for example, PLI already has something like that. I think something more in terms of on the lines of PLI is something I think in India Inc. expects.
With this, we come to an end of the show. Thank you, Mr. Bhatt, for your time. We hope to see you soon.
Thank you very much, Pradeep. All the best.
U R Bhat expects the focus on infrastructure, defense, and employment generation to continue. And he says that Indian equity market typically hasn't had a good time ahead of the general elections. This time, there's a double whammy as global forces are at play too. Ruchika, I hope you have something cheerful in the Budget Nugget segment.
Absolutely. This one is a must watch. I'm going to take you through a world of words or word cloud to capture the essence of any budget.
That's very interesting.
The most often used words and the not so often used words too can tell us a lot about the theme and priority of budget speeches. We analysed the last 4 budget speeches of Finance Minister Nirmala Sitharaman to find out which words were said the most. In her last budget speech of 2022-23, the most used words were digital and capital. The word digital figured 34 times. Let me give you some perspective. In 2021, digital was mentioned only 5 times, and the year before that, just 6 times. Perhaps it was a sign that the world was shifting fast to a post-pandemic virtual age. In the last 3 budget speeches, the word health has found mention much more than before. While the word COVID was mentioned only twice in the previous budget speech and pandemic 10 times, health came up 18 times. In her 2021-22 speech, the FM mentioned COVID 7 times and health 24 times, clearly reflecting the government's concerns about the sector in a pandemic year. In Sitharaman's first budget speech of 2019-2020, in the pre-COVID era, the word health was mentioned only once. In 2021-22, when Sitharaman delivered the shortest speech, just about 90 minutes, infrastructure was amongst the most used words. It came up 29 times. Some of the key words in her short budget speech that left budget watchers enough time for lunch were Atmanirbhar, which came 11 times, disinvestment 8 times. The FM also used the not so often used term well-being in the budget 5 times. The FM's Union Budget 2020-21 speech is among the longest budget speeches ever, clocking in at 2 hours and 40 minutes. The words most used were income, development, infrastructure, and health. There was no mention of COVID, even though cases were being detected globally. Climate is also one word that featured 6 to 7 times in her last 3 speeches. In 2019-20, the year Sitharaman broke Jaswant Singh's record by giving a 2-hour, 17-minute long speech. The word climate was not mentioned even once. In that speech, not surprisingly, the word most used was tax, underlining the government's priority. It came up 123 times, followed by income and infrastructure. Aadhaar too was mentioned 21 times. Words such as yoga and earth also came up in that speech thrice.
Finance Minister Nirmala Sitharaman used the word digital 24 times in the previous budget. During the peak COVID years, the word health was used more frequently than ever before. Ruchika, what's your guess this time? What word will dominate the budget?
Let me guess. I think middle class might feature prominently. Could it be health again because COVID is still around? Jobs also will feature, and G20 should also be featuring quite prominently.
Good guess, and I'm sure the FM is listening. That's all we have for you today. Goodbye and see you on Tuesday.
Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.